Welcome to The Explainer. I am so thrilled you're joining us today because, wow, we are diving into a totally fascinating collision. We're talking about two of the most explosive trends in the modern world right now, the rapidly expanding universe of decentralized finance and the absolute powerhouse that is artificial intelligence. We're going to unpack a groundbreaking new framework called PRISM, which is honestly set to completely rewrite how we think about risk in prediction markets. If you've ever wondered how on earth institutional-grade safety nets can literally be built out of thin air using just language algorithms, well, you are definitely in the right place.
Okay, so here's our roadmap for this explainer. First, we'll cover the prediction market problem. Then, enter the PRISM framework. After that, 5 strategies for hedging. Then, we're putting PRISM to the test, looking at when to use PRISM, and finally wrapping up with maturing an asset class. Let's get right into it.
Starting off with Section 1, the prediction market problem. To really grasp this, we first need to understand the sheer, mind-boggling scale of the landscape we're dealing with. Prediction markets? Yeah, they aren't some fringe, niche experiment anymore. They've gone completely mainstream. $13 billion. That is the staggering monthly volume that Polymarket, the heavy hitter in decentralized prediction markets, was processing by 2025. I mean, it went from under 100 million in 2024 to this absolute behemoth, hosting over 214,000 active markets across everything: economics, politics, tech, you name it. But that brings us to the giant elephant in the room, right? How do you actually manage the risk? Because in traditional finance, it's easy. You buy a stock, you buy a put option to protect your downside, you've got futures, options, this whole toolbox of structured products to put a lid on your exposure. But in prediction markets, none of that exists. If you take a heavy position on, say, whether the Fed will cut rates in September, there's no standard mechanism to hedge that bet, even if perfectly correlated markets are sitting right there on the exact same platform. It has literally been the Wild West. Well, until now. Moving to Section 2, enter the PRISM framework. This massive, glaring gap in the market is exactly what motivated researchers to develop a systematic solution. And they did it by looking at the problem from an entirely fresh angle. Enter PRISM. That stands for Probabilistic Risk Inversion via Structured Market Hedging. It's a mouthful, but what makes PRISM so incredibly innovative is that it actually uses natural language processing. It literally reads the text of the prediction market questions. Using sentence embeddings, PRISM scans the massive, messy corpus of active markets to find semantic similarities. It essentially figures out which markets are structurally related based just on the words they use, and it uses that data to automatically build you a safety net. It's brilliant. Okay, let's dive into exactly how this engine works under the hood. You start out with your query market, so think of a specific bet you've placed. The PRISM engine takes the literal text of that question and encodes it using sentence transformers, computing what's called cosine similarity scores against every single other market out there. From there, it feeds all that data into 5 distinct hedging strategies to sort things out. Each strategy basically acts as a different filter. Finally, all those surviving candidates get passed into a portfolio combiner. This figures out the exact precise weights needed to give you the ultimate hedged portfolio, completely lowering your value at risk and maximum drawdown. Which brings us to Section 3, 5 strategies for hedging. So what exactly are those 5 filters doing? Well, PRISM uses 5 pretty evocatively named strategies to hunt down your hedges. First up, butterfly. This is your maximum inverse insurance. It finds highly similar topics, but bets in the total opposite direction. Then there's corridor, which creates a range-bound hedge by bracketing a specific numerical threshold. Cascade exploits causal chains. It acts as a precondition hedge that resolves before your main bet. Mirror finds cross-domain markets that historically just tend to resolve in a correlated way. And lastly, Sentinel. This one acts as your leading indicator, keeping an eye out for related events that resolve at least 14 days before your primary market. Now, what's really interesting about this is how it all maps out visually. When you run a query for something like a Fed rate cut, the AI text matching process naturally separates into distinct clusters. You'll see butterfly candidates grouping really tightly together, like near a 0.9 similarity, because they are essentially near synonymous variants of the question. Meanwhile, corridor clusters form around, say, 0.6 to 0.7 because they're threshold variants, like asking if a treasury yield will exceed 5%. They aren't redundant, they're providing completely complementary layers of protection drawn from totally different regions of the AI's brain. All right, Section 4, putting PRISM to the test. Because look, theory is great and all, but does this actually protect your portfolio in the real world? The value becomes absolutely undeniable when we look at the stark contrast in maximum drawdown.
The unhedged baseline, just taking a raw, naked position, suffered a catastrophic maximum drawdown of negative 93.7%. Ouch! But when the PRISM hedged portfolio was deployed, that absolute worst-case scenario was pulled back to negative 66.8%. PRISM fundamentally acts as a systematic financial safety net, literally saving you from a near-total wipeout when things go south. So, the crucial point here is understanding the trade-off PRISM introduces. Let's look at the numbers. The unhedged mean return was 9.74%, and PRISM brought that down slightly to 7.31%. Now, you might be wondering, why on earth is that good? Well, because that difference is basically your insurance premium. By giving up just a tiny bit of upside, PRISM radically drops the standard deviation, the variance, the volatility, from nearly 43% all the way down to about 29%. Because the risk drops so much more drastically than the return does, your Sharpe ratio, which is basically the holy grail metric for risk-adjusted returns, actually improves. You go from 0.228 to 0.249. Ultimately, you get a much smoother, significantly safer ride. And this brilliantly illustrates what that smoother ride actually feels like. If you picture a return density chart, an unhedged portfolio has this long, ugly tail dragging out to the left. That represents your extreme tail risk, the truly devastating losses. What PRISM does is sharply compress that distribution. It basically lops off the worst possible outcomes. And it's largely thanks to the butterfly and Sentinel strategies doing the heavy lifting to squash that variance.
Moving on to Section 5, when to use PRISM.
Now that we know for a fact that it works, the big practical question is, when is PRISM actually the most effective? Are there specific market conditions where this framework really hits its stride? Well, the data shows it delivers its absolute greatest value precisely when market uncertainty is most acute. We're talking about markets priced between 0.0 and 0.4, so a probability of 0 to 40%. In this highly uncertain range, PRISM shows a positive hedge benefit in over 70% of positions, which makes total sense, right? If a market is highly uncertain, any structurally related market that PRISM manages to find contains highly valuable information to offset your risk. Now, you might be wondering, does this only work for finance or politics? Nope. Definitely not. When you look at the variance reduction broken down by category, whether you're trading economics, crypto, finance, politics, tech, science, or sports, the risk reduction remains incredibly consistent across the board. It hovers really tightly between 28 and 33%. Because PRISM relies on semantic text structure, it doesn't care what the topic is. As long as people are trading and generating market questions in English, the algorithm can find your hedges.
Finally, Section 6, maturing an asset class. Zooming out for a second, what does all of this actually mean for the macro landscape of decentralized finance? There's a quote from the researchers that I think summarizes this breakthrough perfectly. They wrote, PRISM is the first systematic, algorithm-driven hedging framework designed specifically for prediction markets and constitutes a practical tool for risk-aware participation. That right there, that is the sound of an asset class maturing. The sophisticated tools that allow institutional players and risk-aware retail traders to safely navigate traditional stock markets are finally being built for prediction markets, and they're being built from the ground up with cutting-edge AI. Which leaves us with this final, really exciting thought. We've literally watched polymarkets scale from millions to billions in a matter of months. Now, with natural language processing enabling automated, instantaneous risk hedging through frameworks like PRISM, the historical barriers to entry for large-scale, risk-averse capital are completely falling away. So as prediction markets continue to scale at this breakneck pace, how will this fusion of AI and algorithmic risk management entirely reshape the future of decentralized finance? It's a thrilling question to consider. Thank you so much for joining me for this explainer. I really hope you found this deep dive as fascinating as I did. Keep learning, and I'll catch you next time.